Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Monday, March 14th, 2022. Markets are closed. I wanted to just do a very brief update and give a little more clarification or explanation of that last post I got out to you before the close today. So I give you this chart here. We're looking at a 60-minute chart, hourly candlesticks. 3 months of price history. This is the NASDAQ 100, pretty much same thing as QQQ. And so I shared it as a potential bounce trade. And in that post, if you look at the image, you'll see I had, the brighter arrows are showing this, something along these lines of maybe a bounce up there, 13,390 right there, roughly rounded up to, the nearest, that's what that is, 13,390. And then maybe run up here. Now that's even much more significant resistance level. So here's what I want to talk about. I threw that out there and I made clear that it's not for everybody. It's for active traders, again, those that are nimble, experienced. It's certainly an aggressive, a counter trend trade. The primary, or I should say the intermediate and both intermediate and near term trends, near term being the last few days or so, intermediate term trend being the last few weeks or months, are still bearish. Long-term trend remains bullish. That's the longest term trend, but the shorter term, and this is what active traders are concerned about, what's the near-term and short-term trend, intermediate, and those remain bearish. So as such, that makes an an aggressive trade because it's counter trend. Again, I would be remiss not to point out the reason for that trade is, number one, previous reaction lows, especially big, well-watched reaction lows, are always a significant level. Doesn't mean it always has to become support or have a reaction, but the odds are pretty good. You at least get a tradable bounce. So that was, again, a minimum target, that 13,390. I'll give you comparable levels on QQQ here in a second. And then easily maybe I'll run back up to the trend line. Now, the other alternative scenario I had with the lighter color arrows is we could take out, and this is what often happens, you take it out, it clears the stops, it's called a little false breakdown, aka bear trap, sucks in some shorts, clears out some of the stops on the longs, and then you can reverse and anytime soon. In other words, any marginal new low, meaning a low that doesn't go too far but then reverses, will still be a divergent low because you have these positive, aka bullish divergences down here in place now. You didn't have them at this last high because you were above the previous reaction high. You made high. This was a higher high in prices over that one. Remember, we were in a near-term downtrend, but we finally have taken it out, or at least equaled it. So that gives you the potential divergence, and in a bull market, bull trend, and if that's maybe this correction's over, this is how it usually ends from my experience, and this is where I usually look to cover all shorts and go long. My thoughts haven't changed since the last video. I still prefer a move down to my other targets, but I would be remiss not to point out these divergences as well as what I'm about to show you. The same ones I've been talking about here on the NASDAQ 100, also on the S&P 500, and not just the 60-minute chart, also the daily chart, and also on most of the key stocks. So we're going to talk on that. Now, the other thing is, so while it's sort of sitting right on the edge of a technical cliff, the recent lows. Remember, this is the week of the big, much anticipated FOMC announcement. In a couple weeks back, Powell said he was only going to vote for a quarter point. Again, I don't know why he would say that so far in advance. When I say so far, normally that's not a long time. But in this world today, with everything going on with the volatility in the markets, with the volatile situation over in Europe, 3 weeks can be a life. A lot can happen. And since then it did. Crude went through the roof, and it's since abated a little bit. So look, we'll see. Maybe Powell wants to mix it up and show the people that the Fed is going to be flexible, like he said, and maybe he'll surprise everyone with a half-point hike. I don't know. We know we're going to get at least a quarter point. That's the consensus. And we know he's going to come out with some kind of statement that he always does. We'll be continue to adapt and adjust and do whatever's necessary, blah, blah, blah. In other words, so far it's been almost exclusively rhetoric and jawboning. The market's trying to jawbone inflation down by saying they're going to raise rates but not actually doing it. So we're going to get our first hike this week. It's 100% guaranteed. 100%. We'll get at least a quarter point, And then we'll see what else he says from there. Now, where I'm going, okay, so a lot of volatility. This is a big market moving week. But from my experience, and remember, there's always exceptions to the rules. This isn't hard and set. But from my experience on big market moving Fed meetings, like the one coming up, they start meeting tomorrow, and then they'll do the announcement at 2 p.m. on Wednesday. The initial announcement gets released, press release, and then Powell follows up with a press statement. That's how it works, and says what he needs to say. So back to what I was saying. From my experience, the markets usually will tend to go in a holding pattern. Now, volatility is high as it is. When I say a holding pattern, you're still going to see it's perfectly normal to see 2-3% daily swings. But I think the odds favor between now and after the before the meeting is over, 2 p.m. on Wednesday. I don't think we're going to melt down and have that quick swoon down to my next targets. It is certainly possible. I have seen times where when the Fed is getting hawkish, we saw it back in 2018. That's around the time of the big Q4 drop. The market is stock market is just like a spoiled child, and rightfully so. It screams and kicks and throws a temper tantrum when it doesn't get what it wants. And the problem is, Uncle Powell has spoiled that child, his child, the stock market. And his predecessors before him, Yellen, Bernanke, they gave the market what it wanted, the juice, super low interest rates, and a lot of money being printed, money created, gunning the financial system. And then every time that they talk about taking the toy away from the baby cries. So it is possible that we could see some selling into the before then, but. Again, I think the odds, I'm just telling you from doing this long enough, that will probably kind of meander around. And therefore, when you have especially with the NASDAQ 100 at support, and again, possibility for a little dip, I think the odds are pretty good for a bounce up there. And now, look, they could be, depending on what happens. There's certainly the potential for a lot more because this is a pretty big divergent low right here, all right? And it's on the 60-minute chart. I'm going to show you QQQ now. We're going to jump over to that. We're going to look at SPY. I'll start. I just jumped into SPY. Here's SPY, the S&P 500. And really what stands out, most important thing is you had positive divergence when you hit this 411-ish support level right there. We bounced up. And any marginal new low, like today I told you Q's tested the lows. If SPY were to go down, and that would mean a little marginal new low on QQQ, you'd also have the divergence would be extended. In other words, you already had positive divergence right here. And if we equal or slightly undercut that low, if we go too much, we'll take the divergence out. That's what I want to see. I will metaphorically sleep it better. I don't, I've done this long enough. Markets don't keep me up at night, but metaphorically, I'll sleep better if and when these divergences, especially here, well, both on the 60-minute and daily charts, are taken out on SPY and QQQ, the two big cap. These are the important stocks. They make the biggest difference. The large caps by far dwarf. There's a lot more small and mid. There's a lot more small and mid cap out there, number-wise. But you add up the capitalization of the Nasdaq 100 and/or the S&P 500, which a lot of overlap there. It dwarfs all the rest of the stocks put together. So this is, again, you watch large caps, and that's a much better gauge where everything's going. And you can see on QQQ. Again, we had a positive divergence there, as I pointed out at the time on the daily chart. We got a strong bounce, that big reversal stick, but so far we've been rejected on the downtrend line, and now today's low, equal prices with higher lows in the indicators, is positive divergence. So it would still be if we go a little bit lower, as long as you don't take out the previous lows on the indicators. So that's it. And my guess is it's still going to happen. We'll probably take that out. I wish I could say with the utmost confidence. We're getting darn close. We're halfway between my first and second target already. We're already halfway down there. So it wouldn't be much. Pop down, hit that thing in a day now if we wanted to. Again, it probably won't happen before the FOMC announcement. It's only 6% below. It's possible. And that's it. So I just want to talk about what to expect other than volatility during an FOMC week, a big one like this one, And this is QQQ. You can see the same, divergence right here is where you really pick it up on well, you can go back for a while. It's been building, just that kind of same thing what you're seeing on the daily chart. We had divergence there, and we got a big pop, and we've come on down. The divergence is now extended. So ideally, and again, I speak to multiple traders, multiple investors, because we're all even in the realm of stock trading, whether it's active, very active day trading, swing trading. There's so much diversity among trading styles. It's just like musicians. Let's say, for example, a vocalist or a drummer or a guitarist. There's a myriad of different styles, and musical styles, even instrument styles, acoustic guitar, electric guitar, bass guitar, that kind of stuff. So it's the same way. So I try to speak to those different trading types, and like I said, if you're swing trend trading and not don't do this full time, or you're new to this, don't try to game little counter trend bounces. It's gonna be frustrating. Proof a few dollars, and you'll get a few, but you'll probably miss more than you catch. For those, I would say, and I'm generically speaking, keep your eye on the prize. I've shared my thoughts quite a bit. I'm not going to continue to harp on that right now in this video, but still think my target, that's where we're going. It's just a matter of near term. Let's say those 60 or minute or daily divergences play out. Maybe they take us back up all the way to the breakdown point. Let's just say hypothetically that's the case, that Powell comes out with some big bang and the market loves what he says and they drink it up, and we come back and we test and then take out the 200 days and we go for a full back test of those where the big sell signals came, about 380 on QQQ. That's about a 19% rally. And even if you shorted on the initial short sell signals that we had here, you might still be profitable, but do you really want to get back 19%? So where I'm going, we'll take it day by day, minute by minute. Again, the big fireworks are most likely not going to happen until or like start until Wednesday afternoon, most likely. We'll see. You know me. If something changes, I'll jump in, I'll do updates. So that's it. And again, this is a 60-minute chart of QQQ. Divergences, even bigger divergence if you look at it that way from back here. It's just really this today's slightly incrementally marginally low. I think it was slightly lower than that one, or at least equal. This is still, we just move the line there. The divergence extends, and as would see, there's plenty of room if we have a little put down tomorrow, gap down at the open, as long as we reverse, to still take these divergence lines a little lower and still keep them as positive divergence. Now let's talk about, okay, if things move fast. Again, I'll do updates before the meeting, but let's just say that these divergences start to play out. Well, I'll give you, there's a comparable target about 326.80, first target, next target 334.74. Then you get to the trend line. That's going to be a big level. If that breaks, just so you know, the measured target, not that we have to hit it, but the measured target of a falling wedge pattern is that you take the widest part of the wedge and you add that to where the wedge breaks out. And that would get you all the way up here. And that would mean that the divergences could play out, and the pattern could play out for what it projects to or measures to. And we go up there, and that'd be about 369.52. That'd be about a 16% pop. Again, not too far from what I talked about earlier. The big number, where I really don't want to see any counter trend rally go to, potentially invalidate my longer term targets that I'm still looking at, all the way back here, 378. That could happen and still not really change anything much from a technical perspective. Again, it'd be about an 18% rally, but I'm still looking at these weekly charts, and that's that's what it would look like there. And on the S&P 500, it would be about a to get to that comparable breakdown point, only about 8%, because remember, the Nasdaq 100 fell a lot more than the S&P 500. So anywho, those are the levels I'm watching, and those are the things that could happen overnight. And as I mentioned also on the post, I'm not trying to encourage anyone. I just share my analysis. I share what I see. I share the lessons I've learned over the years. And then you decide what you want to do. But as far as trading futures, again, if you aren't comfortable with them, read all you can, and then or stay away from them. But the reason I mentioned that, showing that for futures, they shut down for a brief period each day shortly after the market closes and then open up. So they're virtually trading around the clock between now and after the market closes, the regular stock market regular session on Friday. And so you can have a stop loss if there's some crazy news at 3 in the morning and you're asleep. There's plenty of liquidity and they'll trigger your stop and you'll be stopped out. And you don't have to wake up to a big gap down, big gap against your position. Obviously, the gap could go your way, but I'm talking about mitigating risk, and you can't do that with the Nasdaq 100. You trade QQQ, it's going to shut down after the after-hour session. Even then, the after-hour session's a pain in the butt to try to trade. You can only use limit orders, things like that. And it's just more difficult, and then liquidity starts drying up towards the tail end of it, and then when it opens up in pre-market session, the liquidity gradually ramps up. So. That's it, really. I just wanted to kind of expand on that chart on QQQ I sent out today, the potential setup. And again, pass if it's not your cup of tea. Right now, there's no signs or evidence of reversal, but over the years, I've learned to respect these divergences, bullish or bearish, and trade them if I think they're going to pan out. And even if I don't think they do or I'm not sure, I'll certainly respect them because I don't want to stay short. I did the reversal, because I'm an active trader in the active trading account. Long-term positions stay where they are. But I don't want to get back, an 18% of profits for no reason. Again, I'm in and out anyways. It's all different. It's, multiple. It's more than 18% counting on the counter trend rallies. But those are the levels I'll watch, and I'll leave it at this. Even if something happens tomorrow and these divergences do play out, and we pop that, as I said in this morning's video, whipsaws are the norm in my experience on an FOMC week. Just as a break to the downside might be. You might see sudden selling, a lot of stops being hit, but then I think the odds are above average that you would have a reversal back in. So again, I take any breakouts with a grain of salt, but I can still trade. Traders have been just keying in perfectly or really nice on these support and resistance levels. So, like anything, take a shot, keep it tight, very tight stop is one option. A little bit looser stop might keep you in the trade and pan out. Up to you completely, or sit tight with where you're at. Or I'll tell you the best advice. I can't give specific investment advice, but generically, if you don't know what to do, you're new to this, stay out of the market. Paper trade or keep a very small amount. Watch and learn. There's always going to be the next big move, the next big rally, the next big correction. Even if we're in a bear market, which I believe early stage bear market, there's always going to be the next leg down. There'll be big counter trend rallies along the way. We'll get those. So that's all. Don't ever feel, don't have FOMO, fear of missing out, and don't feel like the old, what I say, ABT. You don't have to always be trading. That's an old pun off the Glenn Ross, ABC, or what was it? Always be, ABC, always be closing. Those of you that saw that play or the movie will know what I'm talking about. So anyways, you don't have to ABT trade. Don't always trade. Trade the setups that you're comfortable with, and pass on the ones you're not. All right, let's leave it there and get the video out to you guys, and we will pick it up tomorrow for sure. If anything big moves overnight, I'll get an update out to you in the morning. Otherwise, I'd like to watch. I like to wait and see how the market opens. That's where really things are happening lately. This is today right here. Futures are down a little. We popped at the open, and then they faded it real quick. As I always say, the starters, meaning the big boys, the institutions, they step onto the field after the opening bell for the most part. A lot of what's happening now, retail traders moving the futures back and forth overnight, and then institutional. So far, we're seeing just a market under distribution. That's it. You can listen to whoever you want, me included, the other guy or gal. Everyone has their opinion, but nobody can argue. This is a market right now in distribution. The trend is down. So you're going to hear people make a great bullish case why to buy stocks, and they're going to sound great, and maybe they'll prove to be right. Likewise, you're going to hear people that tell you, the henny penny thing. The sky is falling. Get out of everything, and let's just take this one day by day, especially this week. All right, guys, I'm going to wrap it up. This has been Randy Finney with Right Side of the Chart. Have a great night.